Welcome to the OG John AG. If this is your first video here, let me tell you exactly what this channel is in about 40 seconds, and then we will get into one of the most important pieces of data published this year, which almost nobody has read properly. This channel is the home base now. It is where the silver and gold work continues permanently, without interruption. If you found your way here from somewhere else, that is deliberate. Platforms make decisions without warning. Channels get removed, reach gets throttled. Archives disappear on a Tuesday afternoon with no explanation and no appeal. So the work lives here now, and the single most useful thing you can do in the next 10 seconds is hit subscribe, because a subscription is the only thread that survives a platform decision. It costs you nothing, and it is the difference between finding this again and never seeing it in your feed. Second thing, and this matters more every month, there are channels using my name. Close spellings, cloned voices, my analysis re-uploaded, with an affiliate link stapled on the end, some of them running paid promotions and collecting money off the back of work they did not do. None of them are connected to me. So here is how you verify, and it takes one click. Go to the Patreon page. The link is in the description of this video, and it is also sitting in the pinned comment. Anything genuinely connected to this work is listed there. Anything not listed there is not mine, no matter how convincing it looks. That is the entire verification process. One link, one check. All right, let's get to work. Today is Thursday, the 13th of August, 2020. Silver is sitting around $64.78 an ounce, having touched roughly $66 yesterday, which was an 8-week high before easing back today as traders position ahead of the producer inflation numbers. The metal is up more than 10% over the past 30 days and more than 70% over the past 12 months. Gold is trading around $4,400. Now, I could spend this entire video talking about those numbers. Almost every silver channel on this platform will. They will tell you about the Federal Reserve and the September meeting, about the 40% odds the market is assigning to a rate hike, about the Strait of Hormuz still being closed, about Citi reiterating targets of $75 over 3 months and $90 over the next year. All of that is real, and I will touch on it. But I am not going to build this video on it because that is the fast layer of this market, and it changes every 11 days. I want to talk about something that does not change. I want to talk about the single structural fact about silver that, once you actually understand it, makes almost every bearish argument you will hear this year fall apart on contact. And it is not a conspiracy, it is not hidden, it is not suppressed. It is published in a document you can download for free. It is just that nobody reads past the headline number. Here it is, stated as plainly as I can. Silver does not have a supply curve. Let me explain what I mean, because that sentence sounds abstract and it is anything but. In every functioning commodity market on Earth, there is a self-correcting mechanism, and the entire bear case for any commodity depends on it. It works like this. Price goes up. Producers see higher margins. Producers dig more, expand mines, restart marginal operations, fund new projects. Supply increases. The increased supply meets the demand. Price comes back down. The market heals itself. That mechanism is the reason nobody worries about commodity shortages lasting forever. It is the foundation of every economics textbook ever written on the subject. High prices are the cure for high prices. You have heard the phrase 1,000 times. The problem is that this mechanism requires one thing to be true. It requires the people who produce the commodity to be making their production decisions based on the price of that commodity. And in silver, they are not. Overwhelmingly, structurally, they are not. Here are the numbers, and these come out of the World Silver Survey published this year by the Silver Institute and compiled by Metals Focus, cross-checked against the United States Geological Survey's own mineral commodity summaries, which is an entirely separate dataset built by entirely different people using entirely different methods. Of the 846.6 million ounces of silver mined last year, the share that came from mines where silver was actually the primary product fell to a new low of 26%. 26%, a new low, meaning roughly 3/4 of all the silver produced on this planet came out of the ground as a byproduct of digging for something else. Lead and zinc mines produced the largest share of it. Copper mines came second. Mines actually dedicated to silver came third. The USGS, working independently, reaches an identical ranking. Their assessment states that silver was primarily obtained as a byproduct from lead, zinc, copper, and gold mines, in descending order of silver production. Two separate institutions, two separate methodologies, same conclusion. Now sit with what that actually means operationally. When silver goes from $40 to $120 an ounce, that price signal is being broadcast to the entire world. And the overwhelming majority of the people receiving it are copper executives and zinc executives whose capital allocation decisions are governed by the price of copper and zinc. Ask yourself honestly what a zinc mining executive does when silver triples. He does nothing. He cannot do anything. His mine produces the silver content of his ore body, which is a fixed geological property of the rock he is already mining. If he wanted to double his silver output, he would need to go find a completely different ore body, permit it, finance it, and build it, which is another way of saying he would need to become a different company. The silver price signal arrives at his desk as a line item in the byproduct credits column of his cost sheet. It makes his zinc cheaper to produce. It does not make him produce more silver, it makes him produce more zinc. Look at the corporate structure of this industry, and the point becomes almost comical. Fresnillo was the largest silver producer in the world last year at roughly 47.6 million ounces. And yes, that is a genuine silver company. Second place was KGHM, the Polish state-owned group, at roughly 43.3 million ounces. KGHM is a copper company. It extracts silver as a byproduct of copper operations. Read further down the list of the largest silver producers on Earth, and you find Southern Copper and Codelco, which are copper companies. Newmont, which is a gold company. Hindustan Zinc, which is, as the name suggests, a zinc company. Glencore, which is a diversified miner and trader. 6 of the 10 largest silver producers in the world are digging for something other than silver. So when a commentator tells you that high prices will bring on new supply and close the deficit, what they are describing is a mechanism that structurally cannot operate here at any meaningful scale, because the response would have to come from the 26% of the industry that actually answers to the silver price, and that 26% is not growing. It is a record low. Output from primary silver mines fell last year for the 3rd consecutive year. Read that again. In a year when silver averaged $40.03 an ounce, up 42% year over year, and broke above $121 in January, output from the mines that exist specifically to produce silver went down for the 3rd year in a row. That is not a theory I am proposing to you. That is the market having already run the experiment. And here is the closing argument on the whole point, the number that I think is the most important single figure in the silver market right now, and I have not seen a single mainstream outlet lead with it. World mine supply rose 3% last year. And for this year, with the metal having printed an all-time high above $121 in January, with the entire investment world watching, with every producer on Earth enjoying the best margins in the history of the industry, world mine production is forecast to fall by 0.3% to roughly 844.1 million ounces. Down, not up, down. The price went to the highest level ever recorded in nominal terms, and the supply response was negative. If you understand nothing else from this video, understand that. Every bear argument you will encounter this year rests, somewhere in its foundation, on the assumption that supply responds to price. In this market, it demonstrably does not. The experiment ran, the answer came back, and almost nobody is talking about it. Now let me steelman the other side properly, because I am not interested in feeding you a one-sided argument, and this channel is not going to work that way. There are 3 places new supply can come from, and I want to walk through each one honestly. The first is new primary silver mines. This is the theoretically correct answer, and it is also the slowest thing in the entire resource industry. From discovery to first pour on a new mine, you are typically looking at 10 to 15 years. Exploration, resource definition, feasibility studies, permitting, community agreements, financing, construction. Every stage has a queue and a regulator. A mine approved on the strength of today's price does not produce an ounce until the middle of the next decade. So even in the best case, even with unlimited capital, that lever is not a response to this cycle. It is a response to the cycle after this one. The second is byproduct expansion, which is really just a question about copper and zinc. If copper prices are strong, copper mines expand, and more silver falls out of the process as a consequence. This is genuinely the largest realistic source of incremental supply, and it is worth watching. But notice the dependency you have just accepted. Silver's supply now hinges on the capital cycle of a completely different metal. If copper goes into a downturn, silver supply falls with it, regardless of what silver is doing. The tail does not wag the dog. The tail does not even know the dog exists. The third is recycling, and this is the one honest elastic source in the whole system. Recycled silver came in at roughly 197.6 million ounces last year, accounting for about 18% of total global supply. And recycling genuinely does respond to price quickly, because a household deciding whether to sell the silverware is making a decision with a 2-week lag, not a 15-year one. But there is a ceiling on it, and the ceiling is physical. Recovering silver from silverware and jewelry is easy. Recovering it from a solar panel or a circuit board where it exists as a microscopically thin, conductive paste dispersed across a laminated structure is a different problem entirely. The economics of that recovery are marginal even at these prices, and the infrastructure to do it at scale largely does not exist yet. Humanity has mined something approaching 59.5 billion ounces of silver across recorded history, which is roughly 8 times more than gold by weight, and yet almost nobody talks about above-ground silver stock the way they talk about above-ground gold stock. The reason is simple. Most of the gold ever mined still exists in recoverable form. A very large share of the silver ever mined has been dispersed into products, thrown away, and buried. It is on the planet, it is not in the market. So, 3 levers. One is 15 years out, one belongs to copper. One is real but capped and shrinking in effectiveness as silver migrates from spoons into circuits. That is what I mean when I say silver does not have a supply curve. Now here comes the part that I think is genuinely the most underappreciated idea in this entire market, and it follows directly from everything above. If price cannot force an adjustment on the supply side, then it has to force one somewhere. Market's always clear. So where does the adjustment happen? It happens on the demand side, entirely. That is what all of this price action has actually been doing, not calling forth new mines, squeezing users out. And this reframes one of the biggest arguments running in the silver world right now. The deficit for this year is projected at roughly 46.3 million ounces, following a deficit of roughly 40.3 million ounces last year, 6th consecutive annual deficit. Now, various earlier projections had this year's deficit running larger than the official figure came in, and the bear camp has been waving that around as proof that the imbalance is self-correcting. Here is why that reading is wrong, and it is subtle, so stay with me. A deficit narrowing is only bullish evidence or bearish evidence depending on which side did the narrowing. If supply had risen to meet demand, that would be genuine self-correction. The textbook mechanism working. Bearish. But supply did not rise. Supply is forecast to fall this year. So if the gap narrowed, it narrowed because demand came down, because solar manufacturers thrifted silver paste loadings, because electronics manufacturers redesigned around lower silver content, because fabricators who could substitute did. That is not the market healing. That is the market rationing. And there is an enormous difference between a shortage that ends because more metal showed up and a shortage that ends because buyers were priced out. The second kind does not end. It just sets a new floor. Because every ounce of substitution that happened at these prices tells you that the users who did not substitute cannot substitute. What is left in the demand base after the elastic portion gets squeezed out is the inelastic portion, the applications where silver's conductivity has no cost-effective replacement at any price. Electrical and electronics alone consumed roughly 449.5 million ounces last year, close to 40% of total demand of around 1,130 million ounces. That is not a discretionary category. That is the physical infrastructure of the electrified economy. So each cycle of price-driven substitution makes the remaining demand base harder, not softer, more price-insensitive, not less, which means the next deficit is harder to close than the last one, even if the number on the page is smaller. That is the mechanism. Supply cannot respond, so demand gets rationed, and the demand that survives rationing is the demand that cannot be rationed again. At this point, if you have been thinking carefully, you should have an objection ready, and it is the right objection, so let me take it head on. If new mine supply cannot arrive and recycling is capped, then surely the shortfall just gets covered out of the enormous pile of silver that already exists above ground. Vaults are full of the stuff. London and New York between them hold a mountain of it. 6 deficits of 40-odd million ounces against a global stock, measured in the billions, is a rounding error. Why is anyone worried? That is the second escape valve, and it is the one everybody assumes without checking. So let's check it. Registered inventory on the COMEX in New York, meaning metal, that actually carries a warrant and is pledged and available to settle a futures contract, sat at roughly 79.9 million ounces in the middle of May. That is a decline of more than 75% from the peak levels of 2020, In London, vault holdings reported by the LBMA came in around 27,454 tons at the end of April, roughly 883 million ounces, about 20% below the peak reached in January of 2021. Now, I want to be fair here, because these figures get abused constantly by people who should know better. Registered and eligible are accounting categories, not physical realities. Eligible metal can be converted to registered. Metal moves between buckets for custody and tax reasons that have nothing to do with scarcity. Roughly 800 million ounces circulate through refineries and fabrication chains every year, moving through multiple hands before anything gets manufactured. A falling registered number does not by itself prove a shortage, and anyone telling you the vaults are about to hit zero next Thursday is selling you something. But here is the structural point that the official reassurance leaves out, and it is the thing that makes this escape valve narrower than the headline number suggests. Reported inventory overstates genuinely deliverable supply, and it overstates it more as price rises. Think about who owns vaulted metal. A meaningful share belongs to long-term investors, to exchange-traded fund custodians, to strategic and sovereign holders who have no intention of releasing metal at any price currently on the screen. That silver is physically present and functionally unavailable. It appears in the headline figure and it will never appear in a delivery, which produces the opposite of the normal storage dynamic. In most commodities, a rising price flushes supply out of storage, because a warehouse operator holding inventory has every incentive to sell into strength. In silver, above a certain threshold, a rising price locks supply into storage, because a meaningful portion of the holder base treats this metal as savings rather than inventory. And nobody sells their savings into strength. They sell their savings into need. So, the pool of truly available metal shrinks faster than the reported number does, and the gap between those two things widens precisely when the market needs it to narrow. We saw exactly what that looks like in January. During the melt-up in a single 7-day stretch, roughly 33.45 million ounces were physically withdrawn for delivery. That was about 26% of COMEX registered inventory removed from the building in 1 week, not rolled forward, not cash settled, taken out. That is the second escape valve being tested under load. It did not fail, but it flexed a great deal further and faster than anybody watching had assumed it could. Now let me layer the geography and the politics on top, because it makes a rigid system even more rigid. Mexico, China, and Peru together account for close to half of the world's mine production. Mexico's output fell about 5% last year on a combination of operational and policy problems. That is the single largest producing country in the world going backwards in the middle of the strongest price environment the metal has ever seen. And then there is the policy layer, which is genuinely new to this cycle, and which I do not think the market has properly priced. From the 1st of January this year, China implemented export licensing on silver through its Ministry of Commerce, with the framework running through next year, and confirmed a limited list of approved exporters. The same measures covered tungsten and antimony. On the other side, the United States Geological Survey added silver to its critical minerals list, opening the door to trade action, while Washington has repeatedly chosen negotiation over tariffs while keeping the option live. Understand what that combination represents. It is not a supply shock. It is something subtler and more permanent. It is the largest refiner and the largest consumer on Earth, both formally reclassifying this metal from a commodity into a strategic material simultaneously. And here is the operational consequence that never gets discussed. Under a licensing regime, the threat is not denial. It is delay. Review processes take time. A manufacturer running a production schedule cannot absorb an open-ended paperwork risk. So what does that manufacturer do? He builds inventory. He orders ahead. He locks in forward supply he does not need yet, which means the policy itself creates demand that has nothing to do with consumption. Every industrial buyer on Earth hedging against an administrative delay is a buyer who did not exist under the previous regime. That metal goes into a warehouse and sits there as insurance. It never appears in a panel or a board, and it comes out of the same finite pool. So rigid supply, geographic concentration going backwards, a policy regime that manufactures precautionary stockpiling. Stack those on 6 consecutive years of deficits, and you begin to see why the price behaves the way it does. Which brings me back to today, and to the fast layer I set aside at the start. The paper market right now is trading a Federal Reserve question. July consumer prices came in at 3.4%, easing for a second straight month, which combined with a weak jobs report to take September hike odds down toward 40%. That is what pushed silver to $66 yesterday, and gold toward $4,400. The Strait of Hormuz remains closed, and negotiations are deadlocked, which keeps oil elevated. Citi is holding targets of $75 near term and $90 over 6 to 12 months, arguing investment demand takes over from a softening industrial picture. All of that is genuinely market moving, and none of it is my thesis. If the producer price data runs hot tomorrow or the next jobs report snaps back, hike odds jump, and this rally takes real damage in the short term. I'm not going to pretend otherwise, and anyone telling you the price only goes one direction from here is not showing you the whole board. But notice the time frame mismatch. Everything in that paragraph resolves within weeks. Everything in the previous 15 minutes resolves over a decade or does not resolve at all. The Fed can absolutely take silver back to $55. The Fed cannot make a zinc executive drill for silver. That is the distinction I want you to carry out of this video. There is a trading question here, and there is an ownership question here, and they are not the same question. And mixing them up is how people end up selling a 15-year structural position because of a 4-week move in rate expectation. So let's talk practically about what this framework actually changes. If the core insight is that supply cannot respond, then the scarcity is in the metal itself, and physical ownership is the purest expression of that. Coins, rounds, bars in your possession. No counterparty, nobody's promise between you and the asset. You pay for it in storage, in spread, in liquidity friction. That is the insurance premium, and you should evaluate it as insurance, not as a trade. Exchange-traded funds give you exposure without logistics, and for most people building a portfolio allocation rather than a systemic hedge, that is a rational trade. Just be honest with yourself that you own a claim on metal held by a custodian, not the metal. And then there is the piece that this framework changes most dramatically, which is how you look at the miners. If primary silver mines are 26% of world output and falling, if that share is at a record low and primary output has now declined 3 years running, then a genuine primary silver producer is not just a leveraged bet on the metal price. It is a structurally scarce asset. There are only so many companies on Earth whose economics are actually driven by this metal, and that population is shrinking rather than growing. That is a very different way to think about the sector than treating any miner as a proxy for the price. But the leverage cuts violently in both directions, and I will not soften that. Costs are broadly fixed, while revenue per ounce moves with the metal, so margins expand fast on the way up and vanish fast on the way down. Add jurisdiction risk, which given where the world's silver actually sits, is not a footnote. Add management risk, permitting risk, balance sheet risk. A junior explorer can go to zero while the ounces in the ground stay exactly where they are. Size these like the leveraged instruments they are. Now here is the watch list, and I want this one to be different from what everybody else gives you, because if the thesis is supply side, then the indicators should be supply side. Watch primary silver mine output specifically, not total mine supply. Total supply tells you what copper and zinc did. Primary output tells you whether the responsive part of the industry is responding. 3 consecutive annual declines is the current streak. If that breaks, the thesis genuinely weakens. Watch Mexican production and Mexican mining policy. The largest producing country, going backwards for structural rather than cyclical reasons, is the single most consequential supply story in this market, and it gets a fraction of the coverage it deserves. Watch copper capital expenditure announcements. This sounds unrelated, and it is not. Copper capex today is silver byproduct supply in 5 to 7 years. If the copper industry enters an investment boom, that is the most realistic path to meaningful new silver supply, and it belongs in your model. Watch the recycling number in next year's survey. Recycling is the fast lever. If it jumps sharply from roughly 197 million ounces, price is successfully pulling metal out of the above-ground stock, and the deficit has a partial release valve. If it stays flat at these price levels, that tells you the recoverable pool is thinner than assumed, which is the more bullish reading. And watch silver lease rates, which is the one signal on this list that updates daily. Lease rates are what it costs to borrow physical metal. When they spike and stay elevated, somebody needs metal badly enough to pay for it, and no official reassurance changes what a borrowing cost is telling you. Let me bring this home. Every commodity bear case in history has the same load-bearing beam holding it up, and that beam is the assumption that high prices call forth supply. It is such a reliable assumption that most analysts do not even state it out loud, they simply reason from it. In silver, that beam is not there. The market ran the test in full view of everyone. Price averaged $40 last year and printed above $121 in January, and mine production for this year is forecast to fall. Primary output has declined 3 years running. The primary share of world supply hit a record low of 26%. The self-correcting mechanism was given the strongest possible signal it has ever received, and it produced a negative response. So the adjustment goes to the demand side, which means the market clears by pricing users out, which means the demand base that remains gets progressively more inelastic with every cycle, which means the arithmetic gets harder each year rather than easier. None of that tells you what silver does next month. The Fed will decide that, and I'm not going to hand you a price target or a date, because January proved definitively that confident short-term calls in this market get run over by things that have nothing to do with fundamentals. What it tells you is what silver is. It is a market where the escape valve everyone assumes exists has been measured publicly and found not to work. That is the thesis of this channel in a single sentence, and everything I publish here will be built on that kind of work. Not headlines, not price predictions, the structural arithmetic, checked against primary sources, explained in full, with the counter-argument given its fair hearing. If you want the deeper version of this, the full mine-by-mine breakdown, the primary producer list with the byproduct exposure mapped out, the recycling economics, and the lease rate series, that is what the Patreon is for. The link is in the description and in the pinned comment. And as I said at the top, that link is also the only way to verify that anything claiming to be connected to this work actually is. And if you are new here, subscribe to the OG John AG before you go. This is the home base now, and a subscription is the only thing that survives a platform decision made without warning. Invest with logic, never with noise. OG out.